If you've started looking into buying a home in Canada, you've probably run into this fear. I just got here. I have no Canadian credit history. There's no way a bank will give me a mortgage. That's a myth. Every major bank in Canada, RBC, TD, Scotiabank, BMO, CIBC, has a dedicated mortgage program built specifically for newcomers like you. Today I'm walking you through the entire mortgage path, what you need, how much you need to save, and the exact programs designed to get you approved, even with limited or no Canadian credit history. First, who actually qualifies for these newcomer mortgage programs? Generally, you qualify if you've received permanent residence within the last 5 years. Some programs also accept temporary residents with a valid work permit of at least 12 months remaining. Most lenders also want to see at least 3 months of full-time employment in Canada. If you've been working less than that, you're not out of options, but you may need a larger down payment or stronger savings to compensate. If you have longer employment history, even better, it strengthens your application and can unlock better rates. This is the number one question: how much money do you actually need saved? In Canada, minimum down payment rules are tiered based on purchase price. For homes under $500,000, you need just 5% down. For the portion of the price between $500,000 and $1.5 million, it's 10%. Above $1.5 million, you need a full 20% down. As a permanent resident specifically, most newcomer programs allow you to use that same 5% minimum, the same as any other Canadian. Some non-permanent residents may need 10% or more. If your down payment is less than 20%, you'll need mortgage default insurance, usually through CMHC, SAGAN, or Canada Guarantee. This is standard and built into your mortgage. It's not a sign anything is wrong with your application. Lenders need to verify exactly where your down payment is coming from. Here are the accepted sources. Personal savings is the most straightforward, but your bank statements need to show the money sitting there for at least 90 days before your mortgage closes. Gift money from immediate family is accepted too, as long as you provide a signed gift letter confirming it doesn't need to be repaid. If you've been contributing to an RRSP, which we covered in an earlier video, the Home Buyer's Plan lets you withdraw up to $60,000 completely tax-free toward your down payment, as long as it's been sitting in the account for at least 90 days. You then repay it over 15 years. And if your down payment is coming from money in your home country, that's allowed too, but expect to provide extra documentation proving the funds were legally earned, and you'll likely need to transfer the money into a Canadian account 30 to 90 days before closing. Here's exactly what to have ready when you apply: your PR card, or your confirmation of permanent residence if your card hasn't arrived yet. Proof of income, pay stubs, an employment letter stating your role, salary, and whether the position is permanent. Recent bank statements showing direct deposit. Documentation proving where your down payment is coming from. And a summary of any existing debts, credit cards, lines of credit, car loans. Getting pre-approved before you start house hunting does two things. It tells you your real budget, and it makes your offers far more competitive when you find the right place. Let's go through the specific programs worth knowing about. RBC offers mortgages with as little as 5% down for newcomers, even with little to no Canadian credit or employment history. If your down payment is 35% or more, they have special guidelines that work around limited credit entirely. TD requires at least 3 months of full-time employment and PR status within the last 5 years, but explicitly states no Canadian credit history is required if you meet their other criteria. Scotiabank, BMO, and CIBC all run similar newcomer mortgage divisions. CIBC's program specifically accepts people with landed immigrant or PR status within the last 5 years, or foreign workers with a 12-month-plus work permit. Behind most of these bank programs sits CMHC, the Canada Mortgage and Housing Corporation. Their Newcomers program is what actually ensures these lower down payment mortgages, and they're specifically built to consider alternative ways of establishing creditworthiness if your Canadian credit file is thin. The takeaway: you have real options at every major bank. Talk to a mortgage specialist at 2 or 3 of them and compare what each offers for your specific situation. Since most new PRs also qualify as first-time home buyers, there are 2 government programs you should know about. The First Home Savings Account, or FHSA, lets you contribute up to $8,000 a year, tax deductible, up to a $40,000 lifetime limit, and withdrawals for your first home are completely tax-free. Combine that with the RRSP home buyers plan we mentioned earlier, and a couple buying together could access over $100,000 in tax-advantaged savings toward their first home. To qualify as a first-time buyer, you simply need to not have owned and lived in a home, anywhere in the world, in the current year or the previous 4 calendar years. Most new PRs automatically qualify. One quick but important clarification: you may have heard about Canada's restrictions on foreign home buyers. The Prohibition on the Purchase of Residential Property by Non-Canadians Act applies to non-resident foreign investors, not to permanent residents. As a PR, you have the same right to purchase property in Canada as any citizen. This is one of the most common points of confusion for new PRs, so I wanted to clear it up directly. To recap, you can qualify for a mortgage as a new PR with as little as 5% down. Use the FHSA and RRSP home buyers plan to build your down payment tax efficiently. Get pre-approved before you start house hunting. And compare newcomer programs across 2 or 3 banks before committing. Once you've bought your first home, or even while you're saving toward it, the next big question becomes how to protect everything you're building. That means understanding life insurance, health insurance, and what's actually covered under Canada's public healthcare system versus what you need to buy separately. That's exactly what we're covering next. I'll see you there.